Hello and welcome to the Mutual Fund Guide. It's all about your funds and your returns. I'm Vandita Shivle. On the show today with us is Harshvardhan Roongta, CFP of Roongta Securities. Welcome to the show, Harshvardhan, and thank you so much for joining us today. So Harshvardhan, before we begin with our queries, November series is over, December has started. How can it be a merry December for our mutual fund investors? What do you advise?
When you're looking at the, and investing in equities and, December particularly, well, it's not really going to be a merry Christmas for an investor in mutual funds. I mean, if you're picking up stocks per se, if you're picking up specific companies, stocks of companies with a certain underlying theme which works during the end of financial year, maybe yes. But from a mutual fund investor point of view, I mean, the only resolution that you can make, we're now still at the end of the year, but if you really want to get into that mode right now, is that you will invest with discipline. I think 2018 has been a year where you've seen a lot of volatility in the market. We've come across and we've interacted with fund houses where they've also told us that there has been a dip in SIP. I mean, people have started now talking about, should you continue or not. So I think, that resolution or that mode that you should get into is that you will maintain discipline if you're investing via SIPs. So I think that's the only advice for mutual fund investors for the month of December though.
Yeah, so maintain discipline, that's the advice coming in. Alright, we have our first email. Sumukh Mishra from Mumbai has emailed his query. He's 35 years old. He started a monthly SIP in May 2018. He's investing 10,000 rupees in Kotak Standard Multicap, Tata Equity PE Fund, Reliance Small Cap, SBI Small Cap and rupees 5,000 in L&T Mid Cap Fund. He can hold for 7 years and his objective is to save for his child's education abroad, his marriage and his own retirement. He doesn't want to be too aggressive as he is investing 50% of his income. He's asking for our views on that.
So well, Vandita, if you look at the entire construction of portfolio, well, most of the schemes or rather almost are, all the schemes are good. However, I'd recommend one change in his portfolio. So he can stop investing in SBI Small Cap Fund and instead add an IDFC Nifty fund into his portfolio. So in brief, you have to just explain the advantages of investing in an index fund. The first and foremost is there is a, it's very cost effective. So you're investing in any actively managed funds, you will have a fund management fee of approximately 2 to 2.5%. When you invest in an index fund, the fund management cost comes down to almost 1/10. So that's the kind of advantage you have directly in terms of, the cost that you're paying to manage that fund. Besides, if you see the construction of an index fund, you will have, primarily large caps. These are all large cap companies representing each sector in the economy. So in true sense, it is a diversified fund. So you'll have banking, you'll have infrastructure, you'll have FMCG, you'll have all kind of companies representing different sectors put together into one index. So in true sense, you have a diversified portfolio.
Yeah, so you have a diversified portfolio plus you get a cost advantage too.
Absolutely. And it's very easy from an investor's point of view to track it. So if you're an investor, you see that the index has gone up, your portfolio has performed well. If it's gone down, you're getting a negative return for the day. So it's as easy as that. So you don't have to really keep switching into different schemes altogether all the time. So coming back to Mr. Mishra's query, all the schemes otherwise look fine. Just one small change that he can make, he can remove an SBI Small Cap and include the IDFC Nifty fund. And rest all look fine. I think he can continue with the rest of the portfolio.
Alright, so he can stop the SBI Small Cap Fund and he can continue with the index fund.
He can add an index fund into his portfolio.
Alright, so we have our next caller, R. Nandan, who's online from Mumbai. Hello sir, what's your question?
Yeah, I have a mutual fund like few funds. First is Reliance Equity Fund Growth Plan.
Alright.
Invested 25,000. One is Reliance Equity Opportunity Fund Dividend Plan. That is also 25,000. And another fund is Reliance Long Term Equity Fund Growth Plan. And one is Tata Infrastructure Fund Growth Plan. And the rest is Invesco India Growth Plan. So last 10 years I am holding all these funds, and I'm, my objective is these funds are good enough for me wealth creation, or maybe switch some other funds to, growth fast.
So 35 years old, long-term investor, objective is wealth creation, your recommendation?
Well, Anand, you could make certain changes in your portfolio. I'd recommend that you exit out of the Tata Infrastructure Fund. the Reliance Equity Opportunities Fund. Now it has been rechristened into a Reliance Multi-Cap Fund. The Reliance Focus Equity Fund, which was earlier a mid and a small cap fund. You can exit out of these three schemes, and whatever the redemption proceeds that you have, split it into equal parts and invest in the other three schemes which I'm about to recommend to you. So Axis Blue Chip Fund, ICICI Multi-Cap Fund, HDFC Mid Cap Opportunities Fund. So I've added three schemes in your portfolio and removed three. So the redemption proceeds can be split into equal parts and invested into these three companies. All the other schemes you can continue, and I don't really see a reason for you to make any changes in those schemes as of now.
So he can add these three schemes, what you just named, and then his portfolio is good to go.
Yeah, it looks good, and it looks well, in that sense, well balanced and diversified portfolio there.
All right. So that's the advice for you, Mr. Nandan. We have our next email. That's from Shravan. He's from Chennai. He wants to start a monthly SIP of 10,000 rupees for 10 to 15 years. He asks, should he invest rupees 2,000 each in Reliance Small Cap, SBI Small Cap, Canara Robeco Emerging Equities, Mirae Asset Emerging Blue Chip, and one multi-cap fund? He can hold for 10 to 15 years and is expecting 15 to 20% growth. What's your view?
So well, Vandita, I mean, he's selected some schemes, wants to invest at 10,000 rupees, split it into 5 schemes of 2,000 each.
Right.
There is reputation in what he's picked up. So he's got 2 small cap funds, he's got 2 multi-cap funds, large and mid-cap funds. So quite honestly, Mr. Shravan, you don't really need to, split this into 5 schemes. You can do this bit of diversification across 3 schemes also. So what I'll do is, I'll just pick up 3 schemes for you, so that you can split this amount 10,000 rupees that you want to invest every month, and you just get about everything in the market that you're looking for. So the 10,000 can be invested in this manner. Canara Robeco Emerging Equity Fund, this is one of the schemes that you have also selected. Put a 3,000 rupees into this. Invest a 3,000 rupees in IDFC Nifty Fund. We've already spoken about the benefits of an index fund, so that is applicable to you as well. And a Kotak Standard Multi-Cap Fund, 4,000 rupees in that. So you have a multi-cap, you have a dedicated large index fund, and you have a large and a mid-cap in the form of a Canara Robeco Emerging Equity. Well, your expectation of getting about 15 to 20% returns out of this over a period of 10 to 15 years. Well, equities do have a potential to give you a return of about 15% annually. But it's always safe to assume a lesser amount. So if you're expecting in a range of say about 12 to 15% rather than a 15 to 20%, and in case you get a 20% is always welcome.
Right.
But when you're estimating, go with a moderate expectation of getting about 12 to 15% returns, and hopefully and God willingly you will get more than that.
Yeah, I'm sure like multi-cap fund, index fund that you've just mentioned, and large and mid-cap fund. If he has these 3 funds, I think that can help him to get to this level of 15 to 20% growth that he's expecting.
Yes.
All right, we have our next caller, Vijit, who's online from Hyderabad. Hello, sir. What's your question? All right, so I think there's some technical problem. We are connecting with him again. So we'll go with an email. That's from Vijay Singh Ved. He's from Mumbai. He has emailed his query. He wants to invest 15 lakh in debt, liquid or arbitrage mutual funds. He can hold for 5 to 6 years and expects 7 to 8% returns per annum. He's asking for a recommendation. Definitely he's a risk-averse investor because he has also invested in arbitrage funds. So what's your suggestion?
Yeah, so the good part about the query is, very clear with I want to invest for 15 lakh of rupees. I want to hold it for 5 or 6 years. And even better is that the returns expectation are very reasonable, about 7 to 8%.
Right.
So what I'd suggest is that, given the scenario that we are in right now, where credit quality is an issue, where we are seeing interest rate movements being very volatile.
Correct.
So at this juncture, though he wants to invest for 5 and 6 years, what I could suggest is that invest with a view of 1 year. So we'll recommend a scheme with 1 year in mind, so that he gets a short-term debt funds in his portfolio. After 1 year, he can do a review. If he's getting what he's expecting, which is about 7 to 8% with these short-term funds, he can continue with it.
Okay.
In case the returns are not in that range of 7 to 8%, then he may think of adding a longer duration fund. So wherein he could get an estimated, the returns potential in a longer duration is higher. At the same time, if anything has a potential to give you a higher return, if there is a volatility and negative impact on the fund, then you'll also get a lower return. So for that purpose, I'm recommending 2 short-term funds to you. Invest in them 7.5 lakhs into each. keep it for a year, review it after 1 year. If you're getting what you're getting, if you're happy with it, continue with the same, or else at that point in time look to switch to longer duration funds. So HDFC short-term debt fund and Franklin India short-term income fund. You can split your 15 lakhs equally into both these schemes and get going with it.
Yeah, so these arbitrage funds, they will really help in this wobbling market, right?
Yeah, but what we believe is that the opportunities that arbitrage funds will get into these markets may not be living up to his 7 to 8% expectation.
All right.
So and he's a risk averse. So
Absolutely.
okay, arbitrage funds also fall into that category, but you also have to moderate it with the expectation of returns. So we're looking at about 7 to 8% returns. I'm not too sure if arbitrage funds would be able to generate that kind of returns, though they would be more tax efficient.
Absolutely.
But keeping it simple for him, invest into these two debt funds and take a review after 1 year. If they're not doing what they're supposed to do, then you may at that point in time consider arbitrage or longer duration funds.
All right. So that's advice for you, Mr. Ved. We have our next caller, George, who's online from Chennai. Hello, George. What's your question?
Yeah. My question, I put 30 lakhs in BlackRock, DSP BlackRock.
Okay.
Mutual fund, balance fund. I'm getting 24,500 rupees per month. Okay.
Yes.
I'm 78 years old now. Oh, this is what is coming. I just want to know whether I can continue for five years. Now it is 1 year over, and 4 more years are there. So shall I continue for all the 5 years?
Okay, so I think his concern is towards the falling NAVs.
Correct.
And do you advise him, what do you advise him, I mean, in this market scenario?
So, Vandita, let's just understand this query. So, he's a gentleman who's 78 years old.
Correct.
Had 30 lakh of rupees to invest somewhere. Probably he's been guided with the concept of getting monthly dividend out of balanced funds. So, this was a very popular concept at one point in time.
Right.
Where people were advised to invest into balanced funds, which have about 70% equity, 30% in debt.
Correct.
And there is a provision of a monthly dividend being announced out of it. So clearly it is fitting into that kind of advice that was given to him. Now I hope and I believe, Mr. George, that you can at age of 78 take risk with 30 lakhs being invested in a balanced fund, of which 70% is getting invested in equity. So if it's going into equity, then of course you will have an issue of volatility.
Correct.
Wherein as the markets fall, you will see a drop in NAV. So answering the query whether this scheme is good, well, within this category, if you're investing in a hybrid aggressive fund, then DSP, BlackRock, equity and bond fund is a good fund to be in. The question is whether you should be in this kind of a fund or no. I'm unable to answer at this juncture because I really don't know what has prompted you to get into this. But if you're planning to hold on for another 4 years or 5 years from now, scheme is good, you can continue. Have faith in the fact that you're investing 70% in equity and 30% in debt. So if the markets fall, there is going to be an impact on the NAV. So if you are able to withhold and bear that kind of volatility, then continue with the fund. In case you're not aware that this invests 70% in equity and now you feel jittery about the volatility, then you may want to exit out of this fund completely and go to a debt fund.
Correct.
So decide whether you want to be in this fund, this category of funds or no. If within this category, this scheme is good. If you do not fit into this category, then there's a debt fund which you should be looking at.
All right. So that's the advice for you, George. We have our next caller, Vijit, who's online with us from Hyderabad. Hello, sir. What's your question?
Yeah, I'm doing SIPs in a complete of 9 different funds.
Okay.
I'm doing it from the past 1 year.
All right.
So, is it okay if I hold back those funds for a period of 3 to 5 years? Is my question.
Okay, so I think the kind of funds are Reliance Power and Infra, ABSL, Equity Hybrid 95, ABSL Infrastructure, DSP Tax Saver, Mirae Asset and Equity, ICICI Prudential Banking and Financial Services, Reliance Small Cap, SBI Consumption Opportunities and L&T Emerging Businesses Fund. Your recommendation?
Well, Vijit, if you look at your entire portfolio, almost all your schemes are into sector funds, thematic funds or mid and small caps.
Right.
So, if you have consciously created this kind of a portfolio, there's nothing wrong in it if you've consciously and knowingly created this kind of a portfolio, which is a very, high risk, all the schemes are almost all high risk. So, which is sector, thematic, mid and small cap. So, if out of the 9 schemes, you have about 6 or 7 which are into this category, and if you've consciously created, there's no issue, you can continue with this kind of a setup. However, if you're not consciously created, but you've looked at only past returns of what a small cap has done or what a sector fund has particularly done, then I think it's a a wrong approach that you've taken, and you will need to, kind of change that complete, structure of your investments.
There are too many funds in his portfolio.
Absolutely. So 9,000 rupees investing in 9 schemes is 1,000 rupees per scheme is way too much.
Exactly.
But if it's sector, I mean, if he's thinking of infrastructure, if he's thinking of consumption and financial services, he has to split their amount. So if he's consciously created it, fair enough, no harm. But if you only looked at past returns, which many investors do, they just look at past returns a particular category of schemes have given.
Correct.
And they start picking that up. So what has happened in the past for a particular sector may not reflect in the future as well. So returns are not the only parameter that you're supposed to look at while selecting a scheme. So as I said, if it's a conscious decision, then he can continue. The question is, how much can he expect over a period of next 3 years? So because you're investing specifically into certain sectors and themes, if those themes turn out favorable, then you will have very high returns, being generated on your investments because you're investing in those themes. And in case there is a negative impact, I mean negative news, so there will be a negative impact on your portfolio. So you could also see negative returns in that case. And had it been a diversified portfolio for a longer duration of time, say 5, 7 or 10 years in time, then of course you can assume that I have a diversified portfolio, something may not work, something may work. So you put all together, I could expect a 12 to 15% returns. But in kind of a sector heavy kind of a portfolio, it's very difficult to assume what you will generate over the next 3 years or 5 years for that matter.
And do you also recommend him the index fund that you mentioned?
Absolutely. But see, I really don't know what has gone behind him looking and creating this kind of a portfolio. In case, yes, you want to make changes in your portfolio, this is not a conscious decision to invest in this particular manner. I'd recommend that you just look back into the queries that we've handled for other viewers as well. You will get a sense of how you can create a multi-cap. So we've recommended a Canara Robeco emerging equity. We've recommended IDFC Nifty. We've recommended a Kotak Standard multi-cap. We've got an ICICI multi-cap. So these are the schemes that you would add in your portfolio. And with the 9,000 rupees, 3,000 into 3 schemes, I think that formula just solves everybody's problem.
Absolutely. Thanks so much for joining us today, Mr. Harshvardhan. That's all for this edition of the Mutual Fund Guide. Viewers, with our expert guidance, you can save, invest and prosper. Thanks for watching us today. More news and updates on the other side.